Hello, everyone. Today on The Final Bar, I'll be talking with Julius de Kempenaer of RRG Research. We'll talk about all things rotation, particularly two sectors where the RRG is really helping, I believe, understand the rotation at work. Some stocks certainly working just fine, but overall, the major average is struggling as we prepare for the Fed meeting today and tomorrow. Ladies and gentlemen, this is The Final Bar. Hello, everyone. Welcome to The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of technical analysis. The technical toolkit was designed to help investors, to empower investors to better understand the world around them and to focus on actionable movements in the markets. We still apply the lessons that Charles Dow and Edwards and McGee and Wells Wilder and so many that have come before us sort of created and popularized. We're still able to apply those techniques because the markets, I would argue, are still very much driven by human behavior. Now, a week like this, it's not just what's happening on the charts, it's what's happening on the charts and what that can tell us about the conditions around us. We have Fed week, we have a banking crisis that appears to not quite be over. We have a lot of other narratives, a debt ceiling, et cetera, all sort of at play. And that interplay of all those different macro factors arguably are reflected in the charts. So let's focus on the charts the best that we can. Let's get right to our market recap. As I mentioned, sort of a choppy day, but at the end of the day, the market average is finishing a little bit lower. When we look at the S&P 500, you can see it's actually down about 1.2%. The Nasdaq Composite down 1.1%. Having said that, let's get to our poll that we asked you recently. Sorry, I meant to bring that up a moment ago. We actually have a poll going on our live stream page. If you're watching it live on StockCharts.com, you have the poll just to your right. We also have it on our social media accounts. We asked you recently which technical indicator does not imply price direction, but simply measures the strength of the underlying trend. The ADX line is absolutely correct. 54% of you spot on. RSI is actually incorrect. The relative strength index was created by Wells Wilder, who I mentioned a few moments ago. That actually does measure price momentum, but it implies a direction. So the higher the RSI, the stronger the uptrend. The ADX line, the higher the ADX, it has nothing to do with as to whether the stock or the chart is going up or down. It's more about the overall strength of the move. If you want to know more about ADX, I would go to the chart school portion of our website or tune into Joe Rabel's show. He does a really good job of incorporating the ADX into his daily charts. Having said that, let's get to the market recap. As I mentioned, the S&P, the Nasdaq Composite lower today. The New York Composite Index down about 1.4%. I think that's a cause for concern. Mid caps and small caps down as well. Now, the reason why I'm keying in on the New York Composite Index is because it's a broad index with a lot of different sectors and themes and styles that are represented there. And the New York Composite Index, $NYA on our platform, has struggled to get above resistance and has remained below resistance for quite some time. So when I've heard people giving sort of the grand bull case about the markets going dramatically higher, I'm looking at the chart of the $NYA and I'm seeing a chart that's not broken out yet at all. So still unable to do so. And once again today, these averages are pulling back from resistance. We're going to talk about Dow theory, and particularly the new Dow theory, a little later in today's show. We'll come back to the S&P and the Nasdaq and where they're at. The VIX is also worth mentioning, and we're going to look at a chart of the VIX here in a moment as well. Up a good amount today, about 1.7 points to 17.7. Now, this is up from around 16, which is where it was not too long ago. Higher stocks on lower volatility is, I would say, sort of the ideal bull case. If you're bullish at this moment, that's kind of what you'd want to see. Of course, the market going higher, but volatility remaining low, I think would be a key part of that thesis as well. We're not seeing that today. We're actually seeing it go the opposite direction with volatility increasing. Interest rates overall moving lower, and you can see the 5-year point on the yield curve coming down a little bit. 10-year yields currently around 344, long bond yields around 373, and of course the short end is still much, much higher. When the Fed is changing rates, directly affects the short end of the curve. Then there's the ripple effects of how that relates to the long-term interest rate environment. Still very low, and that inverted yield curve, arguably one of the best predictors of a recessionary period, certainly very much still in play here. Bond prices, of course, moving higher when yields are coming down. So the TLT was up about 2.5% today. So very much a sort of flight to safety, I guess, away from stocks and into the bond markets today. Commodities, sort of a familiar look with oil prices lower, and that's not a new development. That's been happening for quite some time. I was doing an interview earlier today, and I was asked particularly about crude oil. My comment was, it's definitely not going higher, and that's not a judgment call. That's just a simple evaluation of the lines on the page. Is the chart going up or down? If you look at the chart of the crude oil future, which is $WTIC on our StockCharts platform, overall it's been going lower, and at best it's just not going up. Down another 5.3% today. That's using the USO, which is a crude oil ETF. The only two in the green are fairly defensive plays, gold and silver. So precious metals continue to move higher. You know what also is moving higher? Cryptocurrencies, which is kind of a bit of a head scratcher. We often think about cryptocurrencies and stocks, or at least at times it certainly felt that way, that they are moving together, right? Stocks represent a risk asset. You're taking on additional risk over a risk-free rate, and as a result, you have greater potential return, but also greater potential risk. When those go down, that means investors are moving away from stocks and taking bets off. Today, you actually have Bitcoin and Ethereum prices going higher, both up over 2%, while the S&P 500, the Nasdaq Composite, were down. That's the lay of the land of where we're at right now. Let's look at some of the charts in a little more detail. This daily chart of the S&P, I think, is crucial in terms of understanding the importance of resistance levels. Before we get to that particular chart, though, I just want to highlight one thing. I have this chart, which I have to focus in on candle patterns. This candle right up here, do you know what that's called? Couple different ways, depending on how you want to label it. But you'd also either have to label a shooting star candle, which is when you open at a certain point, you trade higher, and then you close back near the lows of the day. So a long upper shadow, a minimal lower shadow. That's called a shooting star candle. You could also call it what's called a gravestone doji, which is when the open and close are almost at the exact same level. That's more, again, it looks more like a gravestone. As you can understand probably from the names shooting star and gravestone doji, these are negative patterns. And if you think about what that means, they happen in an upswing, then this candle pops up. So a couple days of closing higher. We open around 41.65 or so. We trade above 41.80, but by the close, we're right back where we started. So initial buying power during the day was met with a lot of interest in selling, and that pushed the price back lower. It usually tells you the next 1 to 3 bars are going to be lower, and that's what we saw certainly today. We saw downside follow through from yesterday, I would argue yesterday's candle pattern. Now, take a couple steps back here. Now we're looking at the last year, and that little part we were zooming into is just this last month. So now we can see how the uptrend in the S&P has led us back up to 4,200. We got above this blue shaded area, which is around 4,100, 4,050 to 4,100. Getting above that, certainly important. Staying above that, it's what's most important. So now all of a sudden we found support in this range a couple times. We found resistance yet again just below 4,200. So I would see this for now as an attempt to get to a new swing high and a fail to do so. This goes back to sort of that Dow theory conversation, right? Of can the S&P and the Nasdaq not just trade to resistance, but upward through resistance? And we're not seeing that yet. You're seeing actually a move away from there. And of course, this is setting up for tomorrow's Fed meeting, right? We'll hear from Chairman Powell. We'll get their latest interest rate information, but then also hear the Q&A. And usually the markets are a little quieter, a little calmer leading into that press conference when you have a lot of volatility, and then investors are left to sort of digest what they heard and what they saw. For now, I would say the S&P getting above 4,200 would be a pretty bullish development, but I haven't seen it yet. And I think what you have to remember in this sort of environment is identify that level, identify that point where you think something is a signal, and then you have to be patient and wait for that to actually play out. I would argue we've not seen that movement just yet. I want to show a chart of the VIX because I think that's pretty important given the fact that the volatility scenario has been fairly low. And I talked to a number of my peers in the industry, some mentors last week in New York at the CMT symposium. My guest today, Julius and Kempenaer, did a great presentation there on rotation using the RG methodology. We had a lot of fun reconnecting with so many of our friends and colleagues that we haven't seen in a couple of years. We talked specifically, or I talked with a number of them about the volatility environment. The fact that the VIX is back at the lows that we saw in 2021. Andrew Thrasher made the comment, we've had him on the show from Thrasher Analytics, basically said, this isn't anything unusual. This is just a low volatility environment. This is where we're at right now. We're sort of in that low volatility scenario. The last time we saw that was in 2021. Now, what you have to remember is when you have a low volatility regime, that's usually during a bull market phase. It's rare that you would have very low volatility and a bear market, because bear markets tend to be noisier, tend to be more uncertain. There tends to be a lot more volatility just by definition because people are panicked, they're nervous. We're not seeing that. We're seeing a low anxiety reading using the VIX. Another conversations or set of conversations I had were about the 0 days to trade or 0 days to expire options, the 0 DTE options, what sort of impact they have on there. Still an open question, and my main takeaway was no one really knows. Even people that have been trading options for decades are still trying to get their head around what this new type of option, which is now the most liquid options out there, what that's meaning for indicators like the VIX. Worth noting, there's now a short-term VIX and then a one-day VIX, a very short-term VIX. We'll be digging into those here at StockCharts in a little more effort, and then we'll circle back and we have some conclusions on what that might mean. But for now, we're seeing the market rally on low volatility. Now, today, a little different with the VIX spiking all the way almost to 18, but not quite there yet. Just to finish off briefly our market recap, consumer at the top of the list. The XLY barely narrowly looks like it stayed in the green. Everything else in the red with financials and energy pushing the way lower. Keep an eye on energy, down another 4.3%. I'm often asked when a chart like energy is starting to look good. My first answer is when it stops going down. That would be a decent place to start. And the problem for the energy sector, when you look at the XLE, is it just keeps rotating lower. Now, what's worth noting is it closed below the 200-day moving average today for the first time since March, so about a week or a month and a week or so ago. The last couple times we got below the 200-day, that was actually fairly short-lived. This is when buyers came in and were able to push the energy sector back up to the upside. The question would be, can crude oil prices recover from here? So far, energy continues to stall out, unable to make a new swing high. So the question is, are we getting anything different this time? And I would argue probably not yet. In terms of what else is happening, we don't have a lot of time to go through individual names, but I would share a chart of KeyCorp. Key, of course, a big regional bank, high yield. And if you think of the dividend yield, the price has come down so much. You're getting an 8% yield right now on KeyCorp, according to the data that I'm looking at here, making a new swing low, down over 9% today. The reason why I wanted to highlight this chart to finish off is two things. Number one, I think this banking crisis is not quite over, and we're seeing that from continued concern on the charts of some of these regional banks. Also, a bullish momentum divergence is only good if we find that higher low, and for now it looks like that is not quite happening. Folks, let's take a quick commercial break. We'll be back answering your questions, we're back talking to Julius de Kempenaer of RRG Research here in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We're coming to you from our studio here in Redmond, Washington. Thanks for being patient. This is our first time having a guest in the studio, and we are working all sorts of kinks out, but we're doing our best to bring you some great content. We hope you enjoy the conversations we're having and what I'm about to have with my guest, Julius de Kempenaer. Before we go there, by the way, a couple quick announcements. First off, we welcome your feedback on our show, but we very much appreciate your questions. We'll have a mailbag on Friday of this week. We love to feature one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'd love to hear from you. Feature one of your questions live on the air on Friday's show. Upcoming guests tomorrow, Wednesday the 3rd, we have Miss Schneider of Market Cage. She will be sitting next to me in the studio here. Then on Thursday, we have T.G. Watkins of Simpler Trading in the studio as well. We, as a group, the four of us actually, will be recording Charting Forward, which will be our second quarter market outlook. We'll be airing that Monday the 8th at 11 a.m. Eastern. Julius de Kempenaer, Miss Schneider, T.G. Watkins, and I will answer all your questions about this choppy market environment, give you some charts and themes to think about. I want to welcome on today's guest, Julius de Kempenaer. Julius is the founder of RRG Research. He's one of my colleagues here at StockCharts.com, usually coming to us remotely from Amsterdam in the Netherlands. Today, we have him live in the studio here. Welcome to Redmond. Julius, good to see you.
Thank you, man. It's an honor to be here and to be actually the first, well, not the first guest, but the first guest in the live show, and that's really awesome.
This is the first of many. Hopefully we have a lot of good conversations in here and easy selection on who should be our first to kick things off. Thanks for joining me here. Let's get to the RRG. You featured the RRG in your presentation to the CMT Symposium in New York last week, which was a lot of fun. Talk us through what you're seeing in terms of market conditions now.
Yeah, so if I look at the markets right now, and people who have watched Sector Spotlight earlier today, I've been touching upon a few seasonality patterns that are present. And it doesn't always happen, but for this month, it looks like two sectors that are poised for outperformance. Those are communication services and technology. They're in the top right-hand quadrant on that RRG, so that aligns perfectly. And maybe even the ones in the lagging quadrant, that's materials and financials, they are lining up very nicely, and that coincides with an expectation for a strong underperformance for both of these sectors from a seasonal point of view. So that's my take on the current market. What I want to talk to you about is I actually want to lift a little segment of the presentation that I did at the CMT last week.
Awesome. Yep.
So basically give the viewers maybe not necessarily a take on the current markets, but how they can make better use of RRG. Because the RRG that's currently on the screen is probably the most watched RRG on StockCharts and pretty much everywhere else. But we can do so much more on this. So if we go load up the one for communication services, if we load up the members of the communication services sector, this one is also quite okay. I mean, people know that you can actually now see the rotation for the individual stocks against the communication services sector. And every time I watch your show, and from time to time that phrase comes up, if you want to outperform the S&P 500, you need stocks that outperform the S&P 500.
That's right.
Quote by Tom Bowley, our good friend, and couldn't be more right. Now, right here, we have the stocks against the communication services index.
Yep.
If you change that benchmark, that XLC, to $SPX, and then add XLC to the group of stocks, then you will get an RRG with what I call a double benchmark. Because what you see now, and if we can highlight XLC, so the XLC tail, then what you see now is the XLC stocks, so the individual members, against the S&P 500, but also against XLC. And if we can animate this right now, that is, I think it blows me away, because what you'll see is the stocks rotating around the benchmark, which is the S&P 500, but you can also make an immediate relationship against the communication services sector. So you can go like best of the best, or look for stocks that are outperforming the S&P 500. XLC is already outperforming the S&P 500, and then you can find the stocks that are outperforming the S&P 500.
Right, so just to be clear on what we're looking at, so we can see the S&P is sort of in the middle of the crosshairs. We can look at where communication services as a sector is by where the XLC is. That's why we've highlighted it.
Yes.
But now we're looking at the individual stocks, so we can see how they're rotating around the S&P, and then how they're relating to their sector benchmark, right?
Exactly, yeah, that's it.
Yeah, right.
That's it, and because of the algorithm, we can compare all of that together, so we don't have to worry about that. And the one that's way out there, that's Meta.
Yep.
So you can immediately see how strong that is actually pulling XLC into the leading quadrant. So I use this a lot to get a better handle on what's happening in a universe. It's great for setting up pair trading ideas.
Can we talk about financials? Because that's an area certainly in the news, and we've got a lot of concerns out there as reflected in the charts. What is the, let's run the Excel of how can I set this up?
Yeah, so here's another thing. So we could do the same thing here, but there's another element to RRG that I want to highlight when I got the opportunity with you. So this is the regular XLF. So kind of spread out, all the stuff in the red, that's the banking stocks. And the one in greens are usually there, like life insurance stocks, consumer investment stuff. So, I mean, basically, financials, if you want to be in financials, just don't be in banks. The rest
other stuff.
Kind of okay, So when we change here, XLF not to SPX, but to $1,
right,
we will get a view of all these individual stocks against $1, which is like gives it absolute price trends. We're looking at absolute price trends, and when you look at this, then here I think this speaks volumes. I mean, this is a pretty clear picture that entire sector is underperforming. It's going into downtrends because that's what it's telling us.
Yeah.
Another thing that, and we probably need to wrap it up right there, is you can use this as a measure of market breadth. So you can run this. So the $1, I use that a lot as a measure of market breadth. And here we've done it for the financials, and you can immediately see that the market breadth, so the support from price trends in financials is really, really weak. And if we can do this for all the individual sectors, and you will find sectors, when the market's going up, you will find them all moving into that same direction. So you can use this setup with a $1 benchmark to get an idea of how that sector is doing. And if you plot them all on one graph, and I've done that a few times in my blogs, you get a really good view of market breadth for the market and the individual sectors. So I think the message for today is that there are plenty more ways to use RRG than just look at the sectors versus the S&P 500.
Yeah, there's all these little layers. And just to remind everyone, I clicked on groups. That's where we have a lot of the and you've done a great job, Julius, kind of making sure there's some really good combinations of tickers and ETFs and things to reflect on there. And also the idea that you can animate it. So I clicked on animate and I hit center, which sort of allows you to follow as these are going and just watch how the financials rotate. And then here in the last couple weeks, you can see how they all sort of rotate to the downside.
That's crazy, right?
We have like another minute. I'd love to look at, you had sent me charts of two of those sectors. I'd love to look at the financial sector if we could, and just look at your chart and how that relates to the chart that we looked at. Here's the chart of the XLF that you shared with me. What does this tell you about the conditions with banks, and is this a time to be looking at for opportunities in this kind of sector?
Well, maybe shorting opportunities.
There's always an opportunity somewhere, right? It depends on what angle.
I mean, if you look at the price chart on the top, that's moving sideways. But what triggered me was that the last bounce off that major support level, just peaked right at the previous low. So this is a perfect example of all support returning as resistance. That's what we're seeing right now. And I think the risk is to the downside, and especially if we take out that, like where these triple bottoms are, when you take that out to the downside, that'd be really bad for financials. If we go to the relative, so the middle pane is what I call raw relative strength. It's just a straightforward ratio. You can see that broke out of that range and sort of started testing its previous support now as resistance. And the result of all that combined is both RRG lines at the bottom, where the RS ratio is already pointing lower, is being pushed further down by that weak relative momentum, the green line. All in all, not a good outlook for financials, and align that with the weak seasonals, as I explained in the start. I don't like financials at the moment.
And I love at the bottom, just so everyone knows, this is basically the indicators that create the RRG. This is looking at it as a time series for the financial sector. So that all of those tickers rotating to the downside is kind of what you're seeing there on the bottom there. The last one I want to talk about then, the other sector we talked about was communication services. Can you contrast what we saw with financials with what we're seeing on the XLC here?
Do I really need to explain?
I think it speaks for itself,
Look at the chart. I mean, it's almost a complete reversal. Look at how that... XLC has been the dog of all these sectors for like a year and a half, and now it's started to come around. You see how it's running into resistance, but it's really pushing. Sometimes you look at the chart and you get the feel like sometimes someone is really pounding on the door to break, and another one is like, and then it sort of doesn't work. So XLC, I think, is like ready to go, and if it takes out that resistance, that overhead resistance there, then we're off to the races. And if you look at the relative strength there, that is turning around. It's a really long-term bottom that we're putting into place there. And that all translates into both RRG lines, that RS ratio line jumping higher, really strong. And we're going through a little bit of a pause. That's where you see that green RS momentum line rolling over. That's because we haven't been able to push above resistance yet. But when that happens and XLC remains inside the leading quadrant, I think this could be one of the better sectors going forward. So, want a tradable idea? Here's your long XLC, short XLF. That's probably stuff that you may want to look at individual stocks inside the communication services sector. Look at some stuff that you don't like in financials, and you got a very nice offset there.
That was like a 10-minute masterclass on the RRG, which was awesome. And this was a short little version of the presentation you did at the CMT Symposium in New York, which was a lot of fun to go there. We reconnected with so many people that we've known for quite some time. I know I met a number of mentors, but everyone should know what's really cool about Julius is he is a thinker. He thinks and continues to evolve the RRG. And that was really the essence of one of my takeaways from your presentation, just thinking about new ways and how to think about different benchmarks and how to relate them. So thanks for what you're continuing to do, growing the toolkit of the technical analyst.
Got a few more things up my sleeve.
More to come then. Julius de Kempenaer, thanks so much for joining us live in the studio here. Good to see you.
My pleasure, man.
All right, folks, we need to wrap it. Go right to the 3 in 3. 3 charts in 3 minutes that tell the story of this market environment. Let's get to chart number 1. All I mentioned earlier in a market recap about what I call the new Dow theory. Charles Dow's work was really driven by the Dow Industrials and the Dow Transports. But in 2023, the Dow Industrials includes banks like Goldman Sachs, and the transports contain airlines and other things that are not necessarily the distributors of goods as they used to be defined in the railroad index. The new Dow theory uses the S&P 500 in the top half, the Nasdaq Composite in the bottom half. This gave a bull-confirmed signal in early February when both the S&P and the Nasdaq made it to a new high for the cycle, broke above previous resistance. That's a big thumbs up. We're not getting that thumbs up now because over the last couple of weeks, we've seen both of these charts stall out at their previous resistance. If and when they can get above their February highs, I would argue that gives an all clear to the market, certainly paints a pretty constructive picture. But it's a big if. We need to get above those levels first, and we're not necessarily seeing it yet. Chart number 2, the McClellan Oscillator. I sort of created this chart using our rectangular or annotations tool to just visually show strength and weakness by highlighting the changes in the chart. The top half is looking at the McClellan Oscillator. When it's above 0, that means overall the breadth conditions are positive. Again, generally speaking, when it's below 0, they're negative. So I highlighted those in green and red respectively. Look at the price action in the S&P 500 during the green shaded areas when the McClellan Oscillator is positive, in the red shaded area when the McClellan Oscillator is negative. We went back below 0 the last week or two in April, and as a result, it suggests further weakness. Right now, though, we're right around that point. Now, sometimes you'll get these quick whipsaws, and that's why I've not quite updated the shading yet, remaining to see what's going to happen. But today, when this updates, most likely it's way back in the negative pattern, which means it looks a little bit like August, September of last year when we rotated below, have a couple bounces, but overall, the trend remains most likely negative. Finally, does anyone need a beverage after this sort of discussion about market rotation and the challenges facing this market? TAP and other beverage companies certainly have done well. Brewers, as represented by Molson Coors, have done particularly well. TAP is up about 7.6% in the market today. What's interesting about this chart, if you look at the last couple of years, and I've unadjusted the data by putting the little underscore in front of the ticker TAP, you can see that this is actually breaking out of a multi-year base. One of my predecessors at Fidelity, a guy named Bill Doan, made a career out of looking for big base breakouts. This was a stock that was in a multi-year consolidation with a consistent resistance level, but then we'd finally break above it. Molson Coors has arguably done that. So 2 takeaways. Number 1, nice breakout. The potential is that for that breakout to continue. So how are you going to lock in additional gains if it does so? The other takeaway, though, is what does it mean when a fairly defensive sector like alcohol or beverages is gapping up and having a great move of things? The average stock does not look this particularly good, and I think it tells you something that staples are continuing to show strength. Watch the RSI on this one. With the RSI well above 80, that's actually called a extreme momentum, I would argue, which means we've potentially gone too high too quick. Wait to see if that trend can settle down a bit. Folks, that's a wrap for this show. Thanks for joining us every weekday after the close for the Final Bar. Special thank you to my guest, Julius de Kempenaer from RRG Research, joining us here in the studio in Redmond. All of our previous interviews can be found at StockChartsTV.com. Also, my presentation, the live edition of the Final Bar that we did from the stage in New York on Friday, is on StockChartsTV.com, also our YouTube channel. So don't miss an opportunity to learn from Ralph Akampora and Luis Yamada. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.